Today I have two interesting stories for you. In the first one, we'll talk about what does China's IPO boom say about the country. And in the next one, we'll understand why did IEA, that's International Energy Agency, change its mid-year electricity outlook for 2026. Hello and welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and bring you the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is 29th of July, Wednesday. On Monday, China's largest chipmaker, CXMT, debuted on Shanghai's star market and rose 466% in a single session. Its market capitalization hit $488 billion, making it the most valuable listed company in mainland China overnight. Chinese retail investors oversubscribed CXMT's offering by 212 times. Perhaps to those of you who may have checked out our recent story on memory chips, this IPO may not be a surprise. But what's interesting is the stock it displaced from the top, the state-owned Industrial and Commercial Bank of China. It is the world's largest bank by assets and also the biggest symbol of how China has financed itself. Over the past year, several of China's largest IPOs have been in the AI value chain. That is chip makers, GPU designers, robotic firms and whatnot. Tech now accounts for more than 30% of the market's capitalization, up from well under 20% just a few years ago. Among the listed companies worth more than $15 billion, technology firms account for more than 45%. Now, this is a dramatic departure from the system that built modern China. For most of its economic miracle, China's financing ran through a very different pipeline that didn't involve any sort of private financing at all. At the core of it were state-owned banks like ICBC that directed credit at extremely cheap interest rates that weren't set by the markets, but by the state. So, what's changed? What does this say about China's capital market? Is it genuinely opening up, or is this the same state-directed machinery wearing a new hat? The story starts with understanding the state financing system itself and the nature of its double-edged sword. China's economic reforms began in 1978, but while the economy seemed to open up, one key part of its economy was deliberately not. And that was finance. Banks were wholly considered instruments of state policy. Their job was to channel the nation's capital towards whatever the state deemed strategically important. That was steel, highway, real estate, toys, smartphones. That too at extremely cheap rates. They complemented this with very low returns on the bank deposits that an average Chinese citizen would have. China deliberately suppresses deposit rates, which aren't set by a market. While China's nominal GDP would grow at 16 to 20% a year, the nominal deposit rate would sit at 3 to 4%, hardly budging. In fact, often due to high inflation, the real return earned from this deposit would actually be negative. Well, Chinese households could go for other asset classes that gave them better returns, right? Not really. And that's where China's capital controls come into play. Not so long ago, Chinese citizens were restricted from investing in stocks and bonds that were denominated in foreign currencies. While the rule isn't as blunt today, restrictions on investing outside, especially the US, continues to exist. The state also makes it difficult for people to buy foreign currencies. China has cracked down heavily on wealthy individuals who try to use the Hong Kong exchange to send money out. On the company side, until the 2000s, the state made it extremely difficult to issue corporate bonds. There were strict quotas on IPOs. The central government literally assigned how many companies each Chinese province could list publicly. And an opaque merit review process meant regulators could freeze IPOs at will. A large chunk of shares in listed companies were held by the state and couldn't be traded. Additionally, local governments, which play a key role in China's economic development, have historically been prevented from creating their own financial instruments. Until 2009, they couldn't raise their own bonds either. In essence, the state was making the low-rated deposit the only game in town, trimming other asset classes that could have given it competition. In economic speak, this combination of low interest rates and capital controls is called financial repression. And it was done in service of China's own state-owned enterprises, local governments, and eventually private companies. This is what funded China's behemoth industrial economy that we see today. India has also had a history of undertaking similar policies, but every economic policy comes with trade-offs. And financial repression is no exception here. We've covered before how China's economy is suffering from a problem of overcapacity and extremely heated competition. The financing system is where those side effects come from. Cheap capital can result in construction of an extraordinary amount of industrial capacity built very fast. But without any disciplining factor, this can quickly turn into too many factories. That in turn creates too much supply, which results in bloody price wars and eventually diminishing returns. Now, China's household savings rate is one of the highest in the world, primarily because, as you might have guessed, the options for deploying those savings were severely limited. In the wake of that, the two biggest asset classes that Chinese people put money in are liquid bank deposits and real estate. And the second one is where we'll train our eyes on. Chinese families bought second and third apartments the way Indian middle class families buy gold or, well, apartments. And why wouldn't they? They saw it as their ticket to godly returns. Property prices in major cities kept rising as private developers like Evergrande or Country Garden built at a staggering pace, racking up incredulous levels of debt on the way. We know how that story ended. China is now going through a historic prolonged real estate crash that has wiped out asset values overnight and continues to weigh on the economy today. It built too much, and now many units sit idle today. The equity market, meanwhile, was always considered volatile and unreliable. And for good reason. Excess competition meant corporate earnings were often poor, while quotas on IPOs prevented better alternatives from emerging. Then, in response to China's financial repression, emerged the weird world of shadow banking. While the debt incurred by various stakeholders in China became unsustainable, China began trimming its state credit. So, state-owned commercial banks began partnering with trust companies to create wealth management products that offered higher yields by lending to riskier borrowers like property developers or local governments, which now found themselves cut off from state-directed finance. Those yields, of course, were more attractive for Chinese people than a simple bank deposit. The shadow banking system eventually grew to trillions of dollars. It filled a real gap, but it was far riskier and much more opaque. It's hard to gain information about the asset pools underlying these WMPs. They can be far weaker than advertised. Shadow banking also often props up unproductive firms. But it's not like China hasn't known about these problems. In the last 2 decades, they've recognized in public that the stock market will have an important role to play in the country's development. After the 2008 financial crisis, state actively encouraged households to invest in stocks. A big reason for why they did so was also what gave rise to shadow banking. The debt levels of companies had become too big and the government didn't want to lend to them anymore and demanded them to deleverage. But these companies still needed capital. The state created this idea of Chinese dream, which was to be achieved partly through a booming stock market. Official state media ran editorials celebrating rising share prices as a sign of economic strength, but the gains were built on sand. Much of the 2014-2015 rally was fueled by retail investors borrowing to invest in stocks. The source of their borrowing was the same shadow banking channels. Many retail investors bought in late. When the bubble burst in mid-2015, the Shanghai Composite lost more than a third of its value in 3 weeks. The government's response was extraordinary here. It ordered brokerages to buy, banned major shareholders from selling, and urged citizens to support stocks in the name of national duty. In fact, Beijing created a national team of state-backed funds that buy equities when the markets fall sharply. The state props up the market when it falls and clamps down on margin lending when it rises too fast. But this is still an artificial means of propping up a company's value. So, in light of all of this, how do we make sense of China's current stock market boom? The AI wave has done something that many previous Chinese industrial booms didn't. It was kickstarted primarily by private companies, not the state owned ones. DeepSeek was built by a hedge fund's research lab. So is Moonshot, the AI lab that broke out frontier model Kimi K3 recently. This, in turn, has implications for the financing question. A report by Rand Corporation puts it clearly. State directed bank lending works well for industries where the government has a clear view of what it needs to be built, which is highways, power plants, steel mills. But AI is an industry where the trajectory of technology is genuinely uncertain, and where the difference between a world changing model and an expensive failure is often unknowable in advance. To its credit, Beijing has known this to be true of high tech industries in general, which is why it's been trying to reform the stock market since 2015. For instance, in 2019, it launched the Star Market Reforms in Shanghai, under which, for the first time, technology firms which were yet unprofitable but were growing extremely fast could list publicly. In 2021, the Beijing Stock Exchange was opened specifically to serve small and medium enterprises. In 2023, China implemented a package of rules which effectively shifted the listing review process from bureaucrats to the stock exchanges themselves. In the last year alone, the star market has received further set of changes. Meanwhile, the deposit to equity rotation is accelerating from the household side. China's bank deposits have contracted 17% from the last quarter, especially since Chinese banks have continued to cut deposit rates. Billions of dollars worth of time deposits are expiring this year alone, and depositors are unlikely to put that back into the bank. And that money is decidedly landing up with brokerages, with deposits by non banking institutions rising significantly in China this year. From Xi Jinping's speeches to real policy announcements, China does look serious about its stock market. But financial repression is nowhere close to being retired, especially as nominal interest rates continue to be pushed closer to zero. Additionally, the stock market might also represent a new form of state control. The same week that CXMT debuted, the national team fueled $9 billion to prevent markets from crashing after an AI sell-off. The CSRC was holding investor symposiums to discuss imported risks from abroad. Regulators were telling brokerages to stop promoting aggressive market views. Some of this is certainly business as usual. It's much like SEC or SEBI would do. But national development through state power has always been priority number one for China. The new channel in IPOs may have emerged, but the logic of strongly steering household savings where the state wants them to go has not. Many governments have tried to do so too, and China is no unique exception to financial repression, but none have matched their scale and intensity. It is not necessary that any of this means that China's growth model is exhausted. It's extremely likely that China's unique model of fusing state direction with private-led innovation continues to work. But what's also very possible is that the same forces that created overcapacity in steel, solar panels, and real estate will eventually create overcapacity in AI labs and chip companies that will become difficult to manage. While history doesn't repeat, it certainly could have high-tech way of rhyming. And now on to the next story for the day. Back in February, the International Energy Agency, or IEA, had just published its annual electricity outlook. We covered that report on the Daily Brief as the arrival of age of electricity because it painted a fairly calm picture of the year ahead. But when the IEA returned with its electricity mid-year update 2026 in July, the tone had changed dramatically. Electricity markets across the countries were suddenly behaving in very different ways and telling a story that the IEA itself had not expected to be telling at the start of the year. According to the February outlook, electricity demand was expected to grow around 3.6% a year through 2030, roughly 2.5 times as fast as overall energy demand. In other words, our economies were steadily becoming more electrified. Meeting that demand also looked very manageable. Clean energy was expanding fast enough to cover most of the growth and gradually even eat into fossil fuels share. Gas would play a role of flexible backup, stepping in whenever renewable generation dipped when the wind wasn't blowing or sun wasn't shining. In that world, coal use would continue to decline. Remember, in 2025, both China and India saw coal-fired generation fall at the same time, which was a rare occurrence. That gave the IEA confidence that power sector emissions would stay broadly flat through the end of the decade, even as electricity demand kept rising. But that picture, all of this, was built on annual averages. The shock in late February exposed what those averages couldn't really show. Hostilities in the Gulf disrupted shipments through the Strait of Hormuz. A large share of world's liquefied natural gas, or LNG, has to pass through this channel. For much of spring, close to a fifth of global LNG supply stopped moving. Resultantly, gas prices in Asia and Europe climbed to their highest levels since the 2022 energy crisis. Asian spot prices averaged more than 65% above the pre-crisis levels, while Europe's benchmark rose more than 50%. The consequences, though, showed up very differently across electricity markets. While in some countries, the prices rose. In others, they nearly halved. And finally, a few countries actually imposed outright cuts in electricity use. So the same fuel shock hit different economies differently. And that's the story the IEA's latest update tells. Now, with a fifth of global energy off the market and its prices up by half or more, running a gas plant to generate electricity suddenly costs more in every country that relied on imported gas. The July update traces this development through the rest of the year. Gas-fired generation, which the IEA had expected to keep growing, is now forecast to stay broadly flat in 2026. That would make this the only third year in this decade without meaningful growth, after the disruptions of 2022 and 2020. Coal, meanwhile, is now expected to grow by about 1.4% instead of declining as the IEA had earlier projected. Part of that is simply because gas became too expensive. When running gas plants costs more than coal plants, utilities switch wherever they can. That was particularly visible in countries like Germany and Poland, where expensive gas reversed coal's expected decline. But expensive gas wasn't the only reason. Weather-driven increases in coal generation in China and India also pushed the global forecast higher. As a result, power sector emissions, which the IEA had expected to plateau, are now forecast to rise by a little over 1% to a record high. The agency still expects emissions to flatten again in 2027, suggesting that this is a one-year bump rather than a start of a reversal. So you see, the same LNG shock hit every country that relied on imported gas. But whether it showed up as higher electricity prices or more coal or simply less electricity depended on four things. First, how much imported gas a country actually needs. Second, whether gas gets to decide the electricity price. In many competitive electricity markets, power plants are switched on from the cheapest to the most expensive as demand rises. The last plant needed to meet the demand sets the wholesale price for every unit of electricity sold during that period. So, if that last plant happens to run on expensive imported gas, even a relatively small amount of gas generation can push electricity prices across the entire market. Renewables change this equation though. Every hour that solar, wind, or hydro can meet demand is another hour gas never gets called upon to set the price. That's one reason this shock hurt a little less than the one in 2022. And even then, consumers don't always see the full increase. Many governments cap retail tariffs, regulate prices, or simply delay passing higher costs onto households. Then there's third reason. What alternatives a country has when gas turns expensive? It could be coal, domestic gas, nuclear, imported power, batteries, or even the ability to shift demand to another time of the day. And the fourth is how governments choose to respond. Do they let prices rise? Do they cap them? Do they suspend the market or simply ask people to use less? Europe and Japan were among the most exposed here. Both relied heavily on imported gas. Both let gas set wholesale electricity prices in their country, and both largely passed those prices on to consumers. So, the shock showed up mainly as higher electricity prices in their countries. Wholesale prices rose more than 30% year on year in the second quarter in Europe, while Japanese power averaged close to $90 per megawatt hour. Bangladesh and Pakistan were just as exposed, but they had fewer options. Both of them relied on imported spot LNG, but they have limited substitutes and couldn't really absorb such a sharp increase in fuel costs. So instead of letting prices increase, both the governments imposed conservation measures that reduced electricity consumption, eventually causing some blackouts. The Philippines chose a different route altogether. It suspended its wholesale electricity market for 5 weeks and replaced it with market prices that were actually administered and controlled. The United States barely noticed. Wholesale electricity prices were broadly flat year on year in the second quarter. Earlier, price increases came from a winter storm in January, but not really the LNG shock. That's because US produces abundant domestic gas. It was largely insulated from what happened in global LNG markets. Australia went the other way. Wholesale electricity prices actually fell by about 45% year on year in the second quarter, averaging $47 per megawatt hour over the first half of the year. This happened in spite of the shock. How come? Well, because strong renewable generation and a rapid growing battery fleet kept expensive gas and coal out of the system, making sure they weren't relied on. New batteries tripled the amount of midday solar that could be shifted into the evening. In effect, Australia had built its insulation before the crisis arrived. India's wholesale electricity prices actually fell about 10%, which sounds wonderful, but there's a caveat here. Imported LNG barely sets the price on India's grid because it plays a very minor role in country's overall power generation mix. So the jump in global gas prices had little influence on the wholesale electricity prices here. But that doesn't mean we weren't affected at all. Because most of the gas used for power generation in India comes from domestic fields, regular electricity prices were protected from global shock. However, factories that rely on imported gas couldn't really afford the new higher prices. As a result, overall gas-fired generation dropped by 15%, meaning the crisis hurt industrial plants instead of consumer power bills. The bigger challenge, however, wasn't really the gas during all this time. It was heat. Electricity demand rose by about 6% in the first half of the year and jumped 11% in May when a severe heat wave drove cooling demand to record levels. On 21st May, peak demand touched an all-time high of 270.8 gigawatts, and the grid met it with solar supplying nearly a quarter of the afternoon demand. But the real test came after the sunset. Solar generation faded just as demand stayed high, forcing the grid to lean much harder on coal and gas. At times, even that wasn't enough. Power shortfalls more than doubled during the first 5 months of the year. And in April, states such as Punjab and Haryana saw up to 2% of their monthly electricity demand go unmet. To hold the summer together, the Ministry of Power ordered imported coal plants to run at full capacity from April to June, as it has done in recent summers. The coal generation rose 3.5%. Nuclear output increased by more than 11% as a new reactor came online, and power sector emissions are expected to rise about 3% in India. This wasn't a response to an expensive imported gas. It was how India managed extreme summer demand once the sun had set. So we understood the power systems across the countries. But a solid power system still can't make the fuel problems go away, but only decides who pays the price. Europe and Japan paid through higher electricity prices. India paid through more coal and higher emissions, as we saw. Bangladesh and Pakistan paid in electricity that never really reached consumers. Australia paid long before the crisis began by investing in renewables and, more importantly, batteries that reduced its dependence on expensive gas. But not every country has the same choices. If the country depends heavily on imported fuel and doesn't have many alternatives or much money to absorb the shock, something has to give. Often, it's the electricity supply itself, just like we saw in the case of Pakistan and Bangladesh. The IEA still believes that this is a temporary setback. It expects gas markets to ease, weather conditions to normalize, and power sector emissions to be flat again in 2027. But that outlook assumes that the next shock will be kinder than this one. One comparison that captures the whole lesson is Australian wholesale electricity averaged at $47 per megawatt hour this year. India's averaged about $48, which is almost the same price. But Australia got here by investing ahead of time in grid that could lean on renewables and batteries. India got there because imported LNG barely sets the price in India's power market. Nearly the same price, resting on two very different kinds of insurances. None of this means that the broader energy transition has gone off track. Renewables are still expected to grow by more than 8% this year. Solar is still headed for another record year, and electricity continues to become cleaner. The IEA's message isn't that electrification has stalled. It's that building a resilient electricity system isn't just about producing cheap power in normal years. It's about deciding where the pain goes when abnormal ones arrive. And now, on to the tidbits for the day. The center has permitted the Reserve Bank of India to print 2 billion polymer banknotes in 10 and 20 rupee number for initial field testing. This move aims to test the increased durability and lifespan of the notes. Next up, Hindalco Industries has submitted the first and sole proposal to the Nuclear Power Corporation of India to set up 220 megawatt small nuclear reactors. This allows the company to secure clean captive nuclear energy to power its heavy industrial and metal manufacturing operations. Next up, Nvidia is discussing a $250 billion financing guarantee to help OpenAI lease a massive 10 gigawatt data center in Ohio. This move would allow OpenAI to control its own computing infrastructure while securing long-term demand for NVIDIA's advanced chips. Next up, South Korean chipmaker SK Hynix is seeking to recover from a $470 billion market sell-off triggered by an investor doubts over the longevity of the AI boom. As a top memory supplier for NVIDIA, the company's stock turnaround relies on big tech companies maintaining high level of spending on AI infrastructure. And finally, Piramal Finance and Muthoot FinCorp have announced a co-lending partnership to provide affordable housing and property loans to underserved borrowers. The collaboration aims to boost formal credit access for small business owners and self-employed professionals across India's smaller Tier 2 and Tier 3 cities. And that's it for today. We'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.